Good day, everyone, from wherever we're connecting from. My name is Damilola in full, fondly known as Illumine, and this video is actually to do a master class about the stock market, and to the end that I clear some things that may not be known, to fill a knowledge gap in the investing in the stock market sphere, if that makes sense. So to not say a lot, I'll just first of all mention that if you're watching this video, please ensure to give it a follow. Very, very important. The reason is it encourages me to bring more videos like this, right? And if you're blessed, why not also, or if you got value, why not also add that as a way of appreciating my efforts, right? So if you haven't yet, kindly hit the subscribe button right away, and if you give this video a like as well, it will go a very long way. Okay, so let's go straight into what we have for today so that we don't waste too much time. All right, so I'll be sharing my screen now, so you would no longer be seeing my face. Let's go straight to the PowerPoint. Yeah, so this is investing class, like I already said, and these are the things we'll be discussing in this video. First of all, introduction. Secondly, the basic stock market terms. Thirdly, how to get started and the strategies for investing, what to buy. Conclusion. Okay, it is going to be as short as possible, but it will be somehow long as well. However, if it's something you really are interested in, I believe you should be able to wait till the end of this video. All right, so let's go straight to the introduction. It's nothing really serious. Introduction: what the stock market is. So what is the stock market? The stock market is actually a market, as its name implies. So it's a marketplace where shares of companies are bought, are sold. Okay, so basically it is where you get to buy shares, where you get to buy a fraction of ownership of a particular company. That is what the stock market is, and also to be able to sell as well when or if need be. So that is what the stock market is. Okay, what is the idea behind it? It actually started in the 1960s. Okay, before I even got to the history, to allow businesses to raise money from investors, while investors also gain ownership and potential profit. So once you buy the stock or the shares of a particular company, two things are going to definitely happen. Number one, potential profit, and number two is ownership. So whichever company you're buying, you become a part owner of that company passively. You need to understand that. So that is why each time I teach about a subject like this, I always love to mention that see yourself as a business person when you are about to start investing in the stock market. When you're venturing into investing like this, see yourself also as a CEO, because you become one once you start investing. Okay, so let me know, because I don't want it to be too much long. Straight to the history. It's actually originated in the 60s, I mean, with Amsterdam Stock Exchange, but now it became global. So even Amsterdam is no longer the headquarters, as it were, if I would use that word. The major player in the stock market now is the New York Stock Exchange, right? So who can invest? Anybody can actually invest in the stock market, regardless of how much you have. Okay, like I said before, now you need to see it as a business. So if you can start a business with 500 pounds or 1,000 naira or 1,000 pound, or maybe $500, regardless of the amount, you can start investing. Just that some things need to change, like strategy and all of those things, but regardless of the amount you have, you can definitely start. Even with $1, you can start with the strategy of dollar cost averaging. Does that make sense? So anybody can actually invest in the stock market, as long as you have access to a broker and a brokerage account, and also access to gadgets like a phone or your laptop. You can definitely start. All right, let's move to the next one. What are the basic stock market terms? Now, this is where it becomes a bit of a bit tricky, if I would use that word. Although this is not everything you need to know about the terms, but this is as much that we can cover within this session. I would also be mentioning some other ones while we talk about this, which I would also explain, but this is the framework of what we would actually be discussing under this particular slide. Okay, so let's talk about stocks. What are stocks and what are shares? Actually, like you can see on the screen at the moment, the both of them means the same thing. Stocks and shares is ownership units in a company, right? However, there's a little difference between the both. When it comes to stock, you're talking about the generic ownership in a company. All right. But when it comes to shares, you're talking about specific units of ownership in a company. Does that make sense? So when it comes to stock, you can tell someone you own a stock. You own the stock of Tesla, or you own the stock of Shell, or you own the stock of BP, right? Or you own the stock of MTN. Does that make sense? But when it comes to shares, you can't say I own the shares of. It is not grammatically correct, even in this context, right? So when you talk of shares, you're being more specific. So instead of saying I own the stock of Tesla, or I own the stock of Nvidia, or I own the stock of AMD, you are a bit more specific by saying I own 10,000 shares of AMD. Does that make sense? So shares specific, stock generic. Does that make sense? All right, let's move to the next one. Market cap. What is market cap? Market cap typically is market capitalization, right? That is the full of market cap. Okay, it basically means the total value of a company's share. So how do you get that? You get that by multiplying the price, the particular trading price of that company by the outstanding number of shares. Okay, so let's say for example, let's cite an example in this case. For example, a company has 1,000 shares invested into it. Like a company has 1,000 shares only, and that company, let's say the name of the company is Illumine, like I always love to say. I see myself having company listed on the stock market in the future, right? So let's say Illumine as a business or as a company is on the stock market and is trading at £100 or $100, as the case may be, right? Let's say 10,000 shares is now invested or owned by Illumine. How do you know the market cap? By multiplying that 10,000 by 100, which is the trading or the share price of that company called Illumine. So that is what the market cap is. Okay, it basically means the total amount that has been invested into a company, actually. Right now, let's move to the next one. Dollar cost averaging. What is dollar cost averaging? Dollar cost averaging is actually setting a fixed amount of money regularly or consistently into a particular stock or a particular equity. Let me just use equity or instruments generally, right? So it could be a particular individual stock, or it could be an ETF or a REIT. Does that make sense? So, but the concept still remains the same. Consistently investing in a particular instrument. All right. The bull and the bear market. What is the bull market? The bull market is the market that is trending upwards, or a rising market, while the bear market is a market that is trending downwards, or a bearish market. Okay, or a falling market. Does that make sense? Now, this is more profound in the crypto space, because for crypto, especially Bitcoin, you always have this season, the bear market, the bull market, the consolidation market, and all of those things in the crypto space. But in the stock market, there is no specific timing for that. It could be any time. But in the crypto space, especially Bitcoin, it is a 4-year cycle, right? And to quickly mention that I would actually be releasing a video which would be paid anyways for you to watch about the cycle of cryptocurrency, specifically Bitcoin, and how you can take advantage to start investing in the crypto market. And let me also quickly mention that I have paid session as well. Okay, I have a one-to-one session, and I also do a stock market investing paid session, paid class, right? One of the wings of this class is wealth building wealth building strategy class, right? That is building 6 ETFs for you to actually start investing into, so that you can maximize the profit you make, thereby building wealth on a faster lane than just investing it in an all-world fund or in an S&P 500. Does that make sense? So these 6 ETFs, they were well researched. Over the years, have outperformed the S&P 500, like the combination of these 6 ETFs together. Does that make sense? And I also have the one for cash flow. I call it my cash machine strategy class. That one is built on REITs, and it is basically to help you to invest in assets that pay you on a monthly basis. Does that make sense? So if you want to be a part of this class, just you see the link attached in the description below. It will directly link you to how you can purchase these classes. Else, you can just DM me on my TikTok page or my Facebook page or my Instagram page, which definitely is on this YouTube page at the moment. And let me also quickly mention that please remember, you have to hit the subscribe button. Encourage me also, so that I can keep bringing videos like this to bless you on a consistent basis. Thank you as you do that. Also, please like this video. All right. So I've already explained what bull market is and what bear market is, right? Now let's talk about EPS. Now EPS basically is earnings per share. Now that's the company's profit per share, and it basically gives you an insight as to how well this company is doing. Okay, what it really means is, for every one share that a person or an investor buys, this is the total amount that the company is making on it. Does that make sense? So let's say, for example, a company is trading at $20, right? And that means one share is $20, and the company is making $5, or okay, let's say like $30. Automatically you already know that this particular company is actually profitable. The reverse is the case, but sometimes it is, or most of the times, it is not the only criteria to check to know the company's profitability, or if it is a good buy for to be added to your stock market portfolio. So let's talk about PE ratio as well. PE ratio is also a criteria for checking how good the company is, to measure the valuation of that company. It basically means price to earning ratio. By the time you know the price, right, to the earnings of that particular company, if it is too high, that means it is overvalued, and if it is too low, that means it is undervalued. How do you know if it is too high or too low? Compare the other companies within the same industry or sector of the company you're trying to do your research on, know the average price and compare it to the price, the P ratio of that particular company you want to buy. Does that make sense? So that is a brief way of explaining it. And I believe it is very clear, right? So now let's move to the next one, getting started. Okay. Now, how do you get started in the stock market? All right. You have to first of all choose a broker, and I would quickly, very important, talk about brokers. A broker is actually someone who mediates between you and the market. So they are like the middleman. They help you to carry out investing transactions and activities on the stock market. So they typically open a brokerage account for you to use. Okay, so it is on that account that every transaction you're carrying out, every purchase you've bought, everything you've sold, you will see it. Every dividend you receive, you see it there as well. Okay, so now you have to ensure some things you need to see before you invest, before you open a brokerage account with that particular firm. Check the company's fee, which we are still going to talk about. Check how user friendly they are. All right. I'll please, so there are certain things you need to pay attention to when it comes to opening a brokerage account. Okay, now the broker you want to use must be such one that would not charge you. Does that make sense? Such broker must or most likely should not be one that would actually charge you. What that means is if you are being charged, right, it will draw you back on your journey of investing or reaching your goal. Does that make sense? So you don't want to use a broker that charges, okay? You want to use a broker that have like zero commission. For example, in the UK here, we have the one they call Trading 212. We have other ones as well, to be honest, but the one I use that doesn't charge, especially if you're a beginner, is Trading 212 here in the UK. However, for some region, like majority of the African countries, you may not see one that would not charge you, but you need to still do your due diligence to ensure that you are not using one that charges too much. So you want to make sure that you are paying the least possible amount when it comes to, fees, platform fees, ongoing maintenance fee, service fee, commission fee, all those things. You want to take them off. Okay. So that is it for a broker or a brokerage account you want to open. And then secondly, the things you should pay attention to is the tax wrapper. So now, let's say, for example, you are maybe in the UK or in the US, you want to pay attention to tax wrappers, right? It's not only these two countries that have tax wrapper, to be honest. We also have, I know one in Africa, right? We have South Africa, which has a tax wrapper as well, a tax-free savings account, TFSA account. Canada also have the same TFSA account. US has Roth IRA, has 401k. UK has ISAs, right? Shares, stocks and shares ISA, SIPP, invested personal pension, right? So there are a lot of them like that you want to take advantage of. Please, if you don't know, first of all, do your research as to which scheme the government of the country that you are residing in at the moment has put in place to help ease off paying tax on your investing. It's available in Germany, it is in France, it's in Spain. You just have to do your due diligence to know those ones to use. Okay. Now, the next thing is to open a brokerage account, right? So you want to open a brokerage account, it will ask you for normal details, right? Normal details like your name, your address, an ID, and all of those things. So just answer those things, and you get started. It may ask you for maybe some document to prove your proof of address and all of those things. Just fill it, and that will be it for opening an account. Then you need to now be ready to invest, right? So be ready to invest. Define your goal. Very important. That's the first thing. Why are you investing? You need to know that. Are you investing towards retirement, or are you investing towards purchasing your first home and all of those things? What is the timeline for you? How long do you want to keep investing in, right? So those are the things you need to be ready to answer as questions before you start. These are the things that will actually back you up when challenges come up, right? Because sometimes you may be challenged, right, on your investing journey, but because you have a goal in mind, you will keep it up, right? You keep on, finding solutions to those challenges. Does that make sense? So that is it for this section. However, let me also quickly mention that if you have any question at all, just put it in the comment section. Very important. I will definitely be answering questions in this, expecting your questions when this video is uploaded. And also, let me remind you again, hit the subscribe button and like the video. It goes a long way for us. Does that make sense? So I believe this place is clear enough. All right, so let's move to the next one, which is strategy for investing. All right, so we have different strategy for investing in the stock market. We have the one that is called DCA, right? It is in full called dollar cost averaging. That is you consistently investing into a particular instrument. I think I mentioned it already before. Not everybody has this big amount of money to put into the market, right? But I believe everyone makes money to some certain degree, right? So every month or money you make, you want to keep a fraction out to invest, right? So when you do it consistently, say maybe bi-weekly or weekly or monthly or bi-monthly, something like that, you want to consistently do it, right? That is what we call dollar cost averaging, okay, into the market. So you're buying the same thing over and over and over and over and over again. In fact, it could be daily, as a matter of fact. Yeah, if you have what you can for daily, please do as well, okay. And the second one is lump sum. So you can lump sum into the market as well. So what that means is you're bringing bulk money into it once, right? And let me also mention that historically, there's higher return in lump summing into the market than there is in dollar cost averaging into the market. In fact, to be more specific, 60% of the times lump sum has beaten dollar cost averaging, right? Meaning that if you are lump summing, you make more money at the end of the day if you contributed the same amount over a long period of time with someone that is dollar cost averaging. Does that make sense? So you're dollar cost averaging and you've invested £10,000 after many years, right? And someone also does the same thing, run summing once and waited for that same number of years with you. The person will have a better return than you who continue to dollar cost average into that 10 years. Does that make sense? So you have to choose the one that is okay by you based on your persona, based on your circumstance. Do you have that lump sum? And if you have it, can you actually take the risk of when the market drops by 1%? So let's say, for example, you lump sum £10,000, for example. That's just a small money, £10,000. But the market drops by 1%. What 1% is in £10,000, I think, is £100. Now, imagine that it's dropping by 2%, by 5%, you see, it's already going up. Would you be able to really absorb that pressure? So those are the questions you need to ask yourself before you choose whether to dollar cost average or to lump sum. But historically speaking and statistically speaking, lump sum always, not always anyways, most of the times beats dollar cost averaging. Okay, now let's move to the next one. What should you buy? Now, this is also something that a lot of people do not know. Okay, so I would just explain basically, and then I would take us to another place where I would explain some other ETFs, which really a lot of people want to do, right? So ETFs, what are ETFs? Exchange traded funds. So these are low risk and well diversified way of investing into the market, right? So instead of going for individual companies, right? Instead of going for individual business like the Tesla, like Nvidia, Microsoft, you're rather going for something that has every of them in one basket. So instead of going for the top 500 companies one by one, just hold on a minute. Right. So ETFs, exchange traded funds. So now the concept or the idea behind ETFs is instead of buying individual stocks like individual companies, you want to buy something that has a lot of individual companies in it, but being sold as one. Does that make sense? So that is what ETFs are. All right. Now we have a lot of ETFs, which we are still going to get to anyways. Now like I said, for ETFs, they are well diversified. Now, imagine an ETF that has up to 500 companies in it. We have that called S&P 500, right? It has tech stocks in it. It has healthcare stock in it. It has real estate stock in it. It has all manner in it, right? So it quickly helps you to be well diversified, right? Then it has lower risk as well because it doesn't move or fluctuate haphazardly. Like it doesn't just go up and down as it were. It is steady, slow and steady, right? That is it for ETFs. And then it is ideal for beginners, to be honest. There are some beginners I know who did not start with ETFs, to be honest, but it is ideal for beginners. But a beginner must, it is not a must for beginners to start with ETFs, but it is ideal for beginners. All right, for individual stock, it is you just buying companies, right? The way we have Microsoft, Meta, Tesla, BP, HSBC on the stock market, you want to buy each of them, right? Those are individual stock. And most of the time, these individual stocks actually come with higher risk, right? Higher risk because it is an individual company, meaning if that company should go broke or go busted, then it affects your investments as well, right? So you don't want to go for individual stocks, but you want to go for ETFs if you cannot bear higher risk. Does that make sense? So we have what we call the okay, potential for higher reward. That is also it. So if you have higher risk, definitely there is higher reward as well. But you need to weigh the two options, right? And then of course you need to be able to carry out research and analysis and all of those things for individual stock. But for ETFs, yes, you may want to do that as well, but not as intense as it is for individual stocks. So let's go for the third one, which is combining both. That is what I actually do. But I now also use a strategy whereby I deploy more fund into the ETFs than into individual stocks, right? So, but you have to do what works well for you, okay? What works well for you. So at this juncture, let me take us to a different view where where is it? Where is it? Where is it? Where is it? Is that it? No. Okay, yeah. So I came up with a list of globally recognized ETFs. And like I said, this is not financial advice. I'm not recommending that you buy them, but I just want to give you an insight and then some lessons to learn because, see, a lot of people make this mistake on a consistent basis, right? Now, look at this. There are globally recognized ETFs that track the most assets and attention from investors worldwide. So I intentionally made it worldwide so that worldwide, I mean, so that whether you're in the UK, in the US, in Canada, in Nigeria, regardless of wherever you are, you can actually invest in these ETFs, right? So while ETF popularity can vary by region, that's US, Europe, or Asia, certain fund consistently sat out because of their liquidity, size, benchmark, and exposure, right? Now let's go to the first one. We have the first one to be, now there's what we call equity ETF. There's nothing really serious about them. So it's just about broad markets or the large cap stock ETFs, I mean, right? So this one is the SPDR, S&P 500 ETF Trust. Now, if you see this, you see there is also the same S&P 500 ETF, right? Now, these are all the same thing. This is one thing I wanted to emphasize. Maybe I'll do another video about it. So we have a lot of S&P 500. Now, what differentiates them, as you can see, is what? SPDR, iShares, Vanguard. Just the same way you want to buy, say, you want to buy a car. So for a car, we have BYD, we have Tesla, we have Mercedes, we have Toyota, right? They are all cars, but they are from different companies, right? This is the same way it is for these as well. They are from different fund providers. SPDR, iShares, Vanguard, we have Fidelity, and so on and so forth. There are a lot of them, right? But these are the most common of them all. Now, like I already said, these are the same, right? They're all the same, tracking the performance of the S&P 500, right? However, if you're in some other region, you may not be able to have access to all these ETFs that have these three ETFs, VO, IVV, and SPY. They are majorly in the United States of America. Now, if you're in the UK, your ETF is different. It is called VUSA, or what's the other one? VUAG, right? One is the accumulation, the other one is the distribution. Both of them are still the same thing as well. But The accumulation version is the one that reinvests your dividend for you. That is the accumulation version of the S&P 500 in UK and in Europe, right? Now, the distribution version actually repays your dividend to you. So you will not receive dividend if you buy S&P 500 accumulation, but you receive dividend if you buy S&P 500 distribution. Does that make sense? That's the only difference. And if you're in Canada, for example, you not even see it as VOO, IVV, SPY, or VUSA, or VUAG. You see it as VFV in Canada, right? So based on the region, the name changes, but what they are tracking remains the same. So everything I've mentioned now, they are all S&P 500 ETF, right? SPY, IVV, VOO, VUSA, VUAG, VFV, they are all S&P 500 ETF. Does that make sense? Right. So was launched. Okay, we don't need all these details actually, right? So this is the total amount that has been invested into it, like what we refer to as market cap, right? But I'll tell you what AUM means much later when we get there. All right. So now let's move to the next one, which is Vanguard Total Stock Market ETF. Now, the reason why I'm actually doing this exposition, by the way, is so that you understand, you have an idea of what you want to buy. Like maybe you don't want to now. For my own course, I help you pick, right? So maybe you don't want to pay for it, which I don't advise. I actually advise that you pay for it, right? So that you can pick the best of them all, the one that will give you the best return. So you're not just paying for the sake of paying, you're paying for the knowledge that I've poured into carefully selecting all these ETFs for you, right? So we have the one that is called the total stock market ETF, right? That is the ticker symbol, which is VTI. Ticker symbol is like that unique identifier in the market, such that no other stock can bear that symbol, right? So that's VTI. It tracks the entire US market. So all these ETFs that you've seen here, they all track the US. They are majorly domiciled in the US. In fact, not majorly, they are all domiciled in the US, right? This one is in the US, this one is in the US, this one is in the US, this one is also in the US. So they only invest in US companies. Does that make sense? Now, right? So now let's move to the next one, which is the international and global market ETF. Now, this one now shifts the focus from only the US to the world, right? We have the one they call iShare MSCI Emerging Market ETF, which is EEM. It provides the exposure to emerging economies like China, India, Brazil, France, and so on and so forth. Those are emerging economies, right? That is the exposure this gives you, right? And it invests in a lot of companies within the emerging economies. It's one of the most traded EM or now EM is emerging markets, right? ETF worldwide, right? And then we have the Vanguard FTSE Emerging Market ETF, VWO. We also have all these things, all these ones, they are just similar actually. This one is also emerging markets. So it's focusing on only emerging markets, right? And then we have this one, iShare MSCI EAFE ETF, EFA, tracks developed markets outside the US and Canada. So you find other countries like France, like the United Kingdom, and so on and so forth, the Australia and all of that. You find them in this ETF, but you never find any US stock or any Canada stock with them, right? And they are very popular amongst global investors as well. So this is just like giving you an insight as to what you can buy, right? So this one is Total Vanguard Total International. Mind you, this thing is actually screen touch. I don't know why I'm stressing myself. So we have the Vanguard Total International Stock ETF, VXUS. So this one is actually a total international stock, excluding the US. That's why it is called VXUS, right? It covers all non-US equities, as you can see, emerging markets and developed markets. Both the developed and the emerging markets, it covers it apart from the United States of America. So now let's go to sector or thematic ETF. Now, when you say sector, of course, you know what that is, right? Invesco QQQ is one of the example of a sector ETF. So basically, it tracks the Nasdaq. What is Nasdaq? Nasdaq 100. That's the top 100 tech companies in the United States of America, right? So it is heavily weighted in tech, Apple, Microsoft, Nvidia, AMD, and so on and so forth. They are one of the most traded as well ETF across the world. And then we have the ARK Innovation ETF, which is ARKK. It is actively managed, focused on disruptive innovation like AI, like biotech, like EV, like robotics, and so on and so forth. That's what you find with ARKK Innovation ETF. It's also it is really volatile, to be honest, right? It's famous because of Cathy Wood's high profile bets, right? That is how this one became famous, but it's one of those ETFs that people actually still invest in. And then we have other ones as well. As you can see, I share iBox, although I don't buy bond ETF, to be honest, because their return is really very bad. That's why I don't buy them. Right, but you can see the list already, and then I really love commodity ETF as well. As a matter of fact, I have one, to be honest. And what are commodities? Of course, commodities, gold, silver, diamond, and all of those things. Those are commodities, right? You can also find oil and gas under commodity. Kind of. No, I don't think so. So it tracks the price of gold, right? That's the SPDR gold share, ticker symbol GLD. So these are actually some of the, the stocks, the ETF. I mean, why am I saying stock? The ETFs you can look to buy, but I always ensure to do your own research, if that makes sense, right? So let's go back to what we are discussing. We'll soon finish in a minute. I think this should be the last, which is the conclusion. Ensure the first thing is mindset, right? Long-term patience is key, okay? In fact, thinking of investing and not thinking that you are investing for the long term is already not investing, right? So when you think of investing, you're already thinking of long term. If you're not thinking of long term, then you are not thinking of investing. That is just the straight response to that, right? So your mindset is really very important. I said in one of my videos that I shared on my TikTok page, I said sometimes we even fall into the wrong stock, but because we are patient enough, we are able to still maximize profits in that wrong decision, in quotes, right? So sometimes patience is that just one key that you need in order to make profit in the stock market. And then compounding works over time. You need to understand that it takes an average of 5 to 7 years before the real compound interest, before you start to see it. It takes up to that, right? But at the beginning stage, it's really very sluggish. Compounding is not showing as it were in your account. But the moment you spend 3 years, 5 years, 7 years, you now see it at work. Every little move is compounded for you. Does that make sense? So emotion, avoid panic selling, avoid all this greedy buying, chasing stocks, FOMO, and all of those things. You want to avoid it. All right. So take out emotions from it, right? Discipline yourself, stick to your strategy, review periodically, check rebalancing. That's also very important under discipline. Rebalance. If anything is happening in the stock, in the global economy, and you think that this particular stock that you are, or ETF that you are owning, is actually having too much portion in your portfolio, you can reduce it and add the portion to the particular sector or industry that you think is better for you. Now, remember that investing is a journey, is not a get rich quick scheme. Okay, it is a long-term thing, and if you can keep to all these things that I've just shared, you are already ready to go. The goal of this video was to take it step by step, and I believe I've done justice to that. Right, so register. For those that already have the knowledge, register, open a brokerage account, right, and go and look for these ETFs if you want to buy, or do your research as to which individual stock you want to buy before you buy. Does that make sense? If there is any question at all, just put it in the comment section, like I said already, and I will be responding to that. I hope to catch you in my next video. Don't forget, if you haven't yet, hit the subscribe button, and I catch you on my next video. Cheers.